traders. Hope you've had a good night. It's certainly been a volatile one. It's to see you've read out there on stock markets this morning with the Dow down around 1% and the S&P and NASDAQ off a little bit more. It was a bit of carnage in European stock markets, which fell heavily. Of the major markets I look at, the smallest loss was 1.75%, and then the DAX, which looks terrible technically, was down 2.14%. The Fed's minutes were out last night, as was US retail sales, but in many ways the story of the night was the crash in crude. The front month fell of NYMEX crude fell 4.9%. The latter months more than 5%. That's taken the price in the front month down to $40.60 this morning. That's a big crash just when it started to look like on the daily basis oil might have been starting to build a base, and some traders went long. What happened last night was that analysts had said that there was going to be a draw of 800,000 in the crude oil stockpiles in the US, but it went the other way with a build of 2.6 million barrels. So that caught the market on the hop, and the market tanked as a result. Clearly, some people who were thinking it might be time to get long got stopped out. I was one of those, and just overall that big build was unexpected and took the market by surprise. Not exactly a black swan, but kind of a grey swan. What that's done is it's changed the narrative around the FOMC minutes. What was clear in the FOMC minutes last night was that they are ready for liftoff. Indeed, one of the members of the FOMC wanted to, I should say, increase rates last month. Obviously, they didn't hold sway, but it's clear that they're ready to go. But only, it seems, if inflation is getting back to that 2% region. There was a big discussion around the table about wages and wages growth and where inflation is in the US and that sort of thing. That was reflected in what Stanley Fischer told us a couple of weeks back. So the oil crashing, the deflationary pulse that comes from that, and lingering concerns about China certainly changed the narrative on what were otherwise a set of reasonably hawkish Fed minutes. So we've ended up with a weaker US dollar, not a stronger US dollar. We've ended up with US bonds lower and global bonds lower as a result of what happened and that discussion about inflation, and also obviously with a 5% fall in the price of energy, because it is the price of energy that largely drove the deflationary pulse earlier this year. And it was the rebound in energy, and remembering it got back up to $65, that drove expectations from central banks that they were the fall in prices was transitory. Clearly, with prices down here at $40 and long-term charts looking like they could go to 32, there is a chance, or there is a likelihood that central banks need to recalibrate their expectations when it comes to inflation. Here's my long-term chart of crude oil going back to 1999 when this rally started. Is it a trend line worth watching? It's had a few touches, so I know traders are watching it. Can we get a rally back towards $48.50 at some point? Probably yes. But it looks more likely than not that we're going to go and reacquaint ourselves with the lows of the 2008-2009 period. So that's going to continue to undermine central banks' deflationary or inflationary expectations. Interestingly, given that, we actually saw a spike in the price of gold last night. What that tells you is that there is growing uncertainty in the market and that traders are worried. Here's it was previously support. So we had a couple of goes, fell, and now we're retesting this $11, $33, $34, $35 region. And that is going to be a key to the next. You've probably got to get a little bit of an increase in uncertainty, an increase in risk aversion for that to go on. But certainly when you've got day after day of equity market losses, you've got continued volatility in China, and you've got continued uncertainty about where global growth really is. Copper prices falling to 228, oil at new 6.5-year lows every other day, the CRB down, those kinds of things. You've got people on the back foot. So when they do that, they go to safe havens. Now, gold hasn't played its role as a safe haven for a while now, but it just might be. Do I have a position? No, not in gold, not at the moment. I want to see where it goes in the next little while. Have I missed a $50 opportunity? Yep. But where it was looking is a bit like trying to buy oil here at the moment. You want to buy it as it breaks higher, not try and pick the bottom just yet after the big falls. Anyway, looking at other markets, and we saw that last night, the move in bonds, the focus on deflation and the inflation rate as opposed to the hawkishness of rate moves, hurt the US dollar a little bit, and the dollar index is down at 96.42. That's allowed the euro to head back above 111. Kiwis around 66, 65.94. Sterling is, where is Sterling on my chart there? I've lost him. 156.80. But the Canadian dollar obviously is getting hammered with the falling oil. Interestingly, the NOK last night went up, hit the top of the range, but came back through. It's in a nice little wedge. I don't have a trade on that one, but I'm watching that at the moment. Elsewhere, I guess they're probably the highlights. Oh, the Australian stock market, it's set to open lower, 38 points down on the SPI 200 futures. It was a remarkable rally yesterday, 1.45% up, driven by the banks, but also driven by energy stocks. So there's going to be a bit of a reversal there today. So you'd expect that to be under pressure. That's really interesting in the context of where the market tried to get to. It tried to break back above and into the previous uptrend. It couldn't do that. So that reinforces that level as overhead resistance, and really does, even though it's trying to build a base on the dailies, really does say, careful with longs and that sort of thing for anything other than short-term time frame. But anyway, we'll wait and see what happens with price action today. And after the remarkable comeback of Shanghai yesterday, even though that the Chinese authorities have still got the training wheels on, they can't afford to lose in Shanghai, and I don't think they will. Interestingly, today I've covered an article by Ambrose Evans Pritchard in the Telegraph over at Business Insider today, so you should have a look at that. He's actually not as bearish as everybody and thinks that some of the doomsday scenarios might look a bit silly by Christmas, but it's worth a read. Even if you don't agree with it, it's always good to challenge your views and read someone else's. Key to his outlook is that he believes that PBOC has got a monetary howitzer in terms of the reserve requirement ratio, and it could unleash a wave of cash into the, I was going to say US, into the Chinese economy. Anyway, let's go around the grounds. Dow Jones was down 0.93% to 17,343. The Nasdaq fell 0.8 to 5,019. S&P was down 0.83 to 2079. In London, the FTSE fell 1.88%. The DAX was down 2.14 and continues to look terrible. Tokyo had a bad day yesterday, down 1.6%. Shanghai managed to finish up more than 1% after being down negative 5.1% at one stage. Hang Seng is the one to watch, so it continues to be down. It was off another 1.3% yesterday. SPI futures, as I said, are looking weak at 5304, and then the currencies we've talked about. So that's it from me today. Have a great day's trade. Good luck. Stay safe. And just remember, it's not a time to be a hero when it comes to position sizing and risk management. That's it from me. All the best. Bye for now.